Good afternoon. Welcome to the Abbott, Stringham, Lynch webinar series on the 2017 Tax Reform Act. This act is commonly known as the Tax Cuts and Jobs Act, effective in 2018. So here we are. Before we get started today, we want to run through some housekeeping items. My name is Malekhedayat. I'm a partner here at the firm, and I head up the Family Wealth Group. Joining me today for this discussion is Chris Madrid. Chris is a senior tax manager here at ASL, and Joshi. Anu is also a tax manager with the firm, and both are members of the tax wealth group as well, the Family Wealth Group. So Anu, can you go ahead and run through some of our administrative items we want to let everyone know before we get started?
Sure, absolutely. Good afternoon, everyone. I'm just going to cover a couple of housekeeping items. The first one is questions. So if you have any questions during the webinar, please use the Q&A feature in the top right corner of the screen, and we'll answer all of the questions at the end of the presentation. Second point, you can print or save the slides if you would like to take notes or if you want to just reference them at a later point. For that, click the multimedia button in the top right corner of your screen, and it will bring up the presentation. Unfortunately, we will not be offering any continuing education credit for this presentation. We apologize for that. If you have to leave early or would like to share a presentation with either someone, your colleagues or your friends, this webinar, in addition to the rest of the series, will be posted to our YouTube channel within a few days. Our YouTube channel is called ASL CPA, so you can go back and refer to it later if you wish to. There will be a brief survey that will pop up at the end of the webinar where you can enter your contact information if you would like someone from ASL to contact you, or if you have any kind of feedback about the presentation. And we would, if you could leave feedback, that would be great. We would really appreciate any comments that you might have.
Great, thanks, Anu. So now we can get to the good stuff. As I think I mentioned before, today we're going to be talking about the tax law changes that impact the individual taxpayers, and we'll also touch on some of the changes to the estate and trust rules as a result of the tax reform. So we've called our discussion today "For Better or Worse?" ? And the reason for that is because with so many wide sweeping changes in the individual area especially, it's impossible for us to take a look at any one person's tax situation and be able to tell without running numbers whether the changes are better for them or maybe not so good for them. In doing our planning after we find out what the tax law changes were actually going to be, we've seen it go both ways. So as we go through what these changes are, some of them will seem like they're good changes on the surface, and some of them will seem like they're taking away good deductions that we really liked having. But overall, there's so much give and take that you just won't be able to tell if it's overall good or overall for the worse. So, but we'll go through and maybe you can be the judge for yourself as how that works. As we run through the individual rules, it'll be really helpful also to keep in mind that almost all of the changes that were made for the individual tax updates were written to sunset in 2026. So they're really only in effect between 2018 and 2025. Now, this is different than the corporate tax changes because those changes were all made permanent. So that means we have a window, and it's a window of opportunity if these changes are good for you, and it's a window maybe of not so good times that will be ending. Of course, there's always a chance that Congress will make changes in between now and 2025, or maybe slightly after that. But if they don't, in the absence of any additional legislation, everything at the end of 25 will revert back to the way things were in 2017. So that's good to keep in mind. So the first thing let's take a look at are the new tax rates effective in 2018. This is, of course, one area that everybody who does a tax return in 2018 and going forward until the sunset is going to be seeing the effect of the new tax rates and the new tax brackets. For the most part, the changes that were made, even though they didn't reduce the number of brackets, which is something that was in at least one of the proposals, we still ended up with 7 tax brackets. beginning at 10% on the low end and now ending at 37%, where before it was 39.6% as the top bracket. So we still have those 7, but for the most part, the percentages of the tax rates has shifted down for most of the brackets. 35%, we still have that same bracket as a percentage is unchanged, but another change that for the most part we see overall is that the amount of taxable income that fits within each of the brackets is different under the new laws as compared to what they were under the old laws. So we can take a look at one example of how this difference shows up. With the 7, let me see, I wanted to point out the middle tax bracket. So now our middle tax bracket is 24%, and as opposed to the 2017 tax rate, the bracket was 28% in the middle bracket. So on the slide, we've highlighted the 24% row as the middle, as opposed to 28%. And you can also see, if you look under the married filing jointly tax bracket, when you go down to the 24% line, a married couple filing jointly can have up to $315,000 and still fit within the 24% bracket as their top tax rate. Whereas if you were to look at the 27 tax rates, only $233,000 approximately was able to fit within that tax bracket. So it was a lower dollar amount. It was $233,000, and it was at a higher rate. So on the surface, it looks like this is a good thing. But a caveat to keep in mind is we're not going to be able to take our 2017 taxable income and plug it into the 2018 tax rates and say, hey, you know, look, I'm paying less taxes. And the reason is due to all of the other changes that were made. So there were changes to how we recognize income, there were changes to what's taxable, there were changes, as most of us, you know, heard in the news, to itemized deductions. So at the end of the day, the whole calculation as to how individuals come up with their taxable income has dramatically shifted. And so first we'll have to go through what those changes are before you can come up with that magic number that you end up putting in to your new and improved tax brackets. Before we go into the income changes, I just thought it would be fun to take a look back in history at what top tax rates were. Lately, we've been used to the 39.6%, which has kind of been back and forth in the last few decades. Before that, it was as low as 28%, most recently in the late 80s and early 90s. So we've kind of been in the same area, the around 30, 28 to 37, 30, 40%. So that is a little bit of window, but not as high as 94% in 1940, in the early 40s. So that's something to be thankful for. But probably it will never go back down to 7% like it was in 1913 when we first had income taxes come into being. But it's just kind of fun to see how federal tax rate, the top rate, has gone up and down. So here we are. We're kind of in the middle on the low end, so not too bad. I think we're on the right track. So we talked about ordinary income tax rates and brackets. I just wanted to say a few words about capital gain rates. The rates themselves have not changed. They're still at 0%, 15%, and 20%. And just as a reminder, we're talking about long-term capital gains, which is gain on assets that you've held for more than a year. If you've held your asset less than a year and sell it, then that gain doesn't qualify for the preferred rate. It is taxed like other ordinary income. So long-term capital gain rates in 2017, in order to determine which of the capital gain rates was your top rate, you just had to look at your tax bracket for all your ordinary income. So the first two brackets, the 10 and 15% bracket, if your ordinary income was in that bracket, your capital gain rate was actually 0, and then it went up with higher income under those brackets. The way it works now is we have the same, basically the same concept, except you won't be looking at your tax brackets to see which capital gain rate applies to you. They've actually just converted the old brackets into dollar amounts and adjusted them a bit for inflation for 2018. So now in order to see which top capital gain rate would apply to your long-term capital gains, you'll have to look at these income level breakpoints that are listed on the slide here. And again, they may change a bit from year to year because of inflation, but it's a little bit of a different concept. But at the end of the day, it's not too different from the way it was before tax reform. So now we'll take a look at adjusted gross income and some of the changes that were made in doing that. And adjusted gross income, again, is just as a reminder, we're kind of looking at a tax return, and before we get to take any deductions, as like itemized deductions or the standard deduction, we have to add up what is all of our income that's taxable. So one of the changes that came into being that was kind of a surprise, I don't remember hearing any discussion about it, was the way alimony is taxed. So as long as I can remember, alimony has been a deduction on the income tax return of the person who's paying the alimony, and the other spouse who was supported by the alimony was picking up the income on their tax returns. Now it's going to be flipped. It will be the other way around, so that the person who earns the income pays the taxes, and the person who receives them is not required to pick that income up on their tax returns. We do have a window before that actually takes effect. That is scheduled to be effective for agreements executed after December 31, 2018. So during this year, if you haven't finalized a document that's in the works, you still will be under the old rules. There is a grandfather clause as well, so that documents that are in place under the old rules can still be modified, and in that case they can elect whether or not they want to use the new rules or the old rules. So there is some flexibility there, and of course that's going to be a big deal for people who are trying to work out their marital settlement agreements. Another item that traditionally has been an expense that you would take in arriving at your taxable income is moving expenses. Moving expenses, as we may or may not know, it's not always obvious that they were related to work-related. If you had to move for a job and you had to move at least 50 miles or more, something like that, for a job-related required move, then you were able to deduct some of your moving expenses. That piece of it is no longer around, but it does still apply to members of U.S. Armed Forces. Another item, probably a good item for some people to keep in mind, is if you work for a company that has options, stock options, certain stock options, and restricted stock units, at some point there was a requirement to pick up that income or recognize that income related to those equity compensation pieces when the transaction happened. Under this new election, which starts in 2018, qualified taxpayers of qualified businesses will have the option of making an election for up to 5 years of deferring recognizing the gain from these certain stock options and RSUs. A key point of that, though, to keep in mind as you work through who qualifies and who doesn't, is that it does not apply to stock of public companies. So primarily then here, that rules out a lot of companies, and so the first thing you would want to look at is if it's a privately held company, then this could really be a good election to consider. There are a lot of strings attached to it, so it's not something that you can say yes or no without diving into the details. So, but it's a good thing to be aware of, so a heads up there. And then finally, what I wanted to talk about in relation to income and expenses in arriving at adjusted gross income is the net operating loss deduction that refers to business losses on a personal tax return. And these would come about from, well, typically a Schedule C business or from pass-through K-1 income from ownership of partnerships or something like an S corporation or LLC. So where these pass-through type of income, business incomes, are taxable on the individual tax return, that leads to also being able to deduct the losses on the individual tax returns. In the past, we've had the opportunity when you had a loss in a current year to be able to go back 2 years on 2 years' tax returns and apply that loss to taxes and get refunds of taxes that you paid in prior years. So that really was a nice feature because you were able to get a refund this year when you had a loss in this year. And then any excess losses that weren't used up in those 2 years could be carried forward for up to 20 years to offset income in those years. Now, the changes, there have been a few changes here. One is that we can no longer carry back and get refunds of taxes from earlier years. So we're kind of stuck now with having to go forward with our net operating losses. And not only that, when we do that and apply it going forward, we can't offset all of our income in any one year. So we used to be able to offset 100% of income in a specific year and pay no taxes in that year. Now we can only offset 80% of our taxable income. So you'll still have some tax liability in those future years, but another good point is they've taken away that 20-year carry forward and set it up so that we can take it indefinitely. Although I've never seen anybody do it for more than just a few years. So I think if you have an NOL that goes for more than 20 years, I think you've got some issues there.
More problems than just an NOL carry forward.
Exactly. So that wraps up most of what we were going to talk about on the income side. A lot of what the press has been talking about in leading up to the final tax laws, and we all know about, is itemized deductions, and rolled into that is exemptions and some of the other deductions. So these are significant changes that I know everybody really is trying to get a handle on. So Anu's going to go ahead and walk through a lot of those changes with us.
Thank you, Julie. On this slide, I have a comparison between the 2017 standard deduction and exemption amounts and what it is going to be under the new law. So as you can see, the 2017 deduction amounts, if you compare them to 2018, in 2018, that amount has almost doubled. So on the surface of it, it looks really good. On the other hand, the personal exemption that a taxpayer used to get of $4,000 has now been taken away. So, you cannot, it seems like if you take, like, for example, a Madrid filing joint return for 2017, they would get a standard deduction of $12,700 and a personal exemption of $4,000. So they got about $16,000 of deductions from their adjusted gross income. In 2018, they're getting way more than that. They're getting $24,000. So the deduction having been gone up, that reduces their taxable income. So that's a good thing. However, one thing to keep in mind is that a lot of times in the past, personal exemptions used to get phased out depending on your adjusted gross income. So if your adjusted gross income was over a certain threshold, then you never really got the benefit of that personal exemption to begin with. So whether this really makes a big difference for you or not, again, like Julie mentioned at the beginning of the presentation, on the surface of it, it looks like you might actually come out ahead, but you will also have to look at the changes in your adjusted gross income to figure out how much of this really affects you in 2018. The next item I want to talk about are the itemized deductions. There has been considerable changes to this particular line item on the return, and I'll cover most of them on this slide. So the first thing that they did was, previously, they used to have an overall limitation on the amount of itemized deductions that you could take. So that deduction phase out has been eliminated. So you can take all of the itemized deductions now going forward without having any of it limited because of your adjusted gross income.
So that deduction is the one that we're calling a haircut, right?
That's correct. That's correct. And I think, like, again, it seems really great. There's no phase out anymore. But as I'll go through these slides or the items on this slide, you'll realize that while it seems like a good thing, they have also taken out so many of the deductions that it may or may not be a good thing.
There aren't really many left.
Yeah, so it'll be interesting to see how that kind of ends up in every taxpayer situation. Medical expenses. So under the previous law, the amount of medical expenses that you could claim as an itemized deduction was limited to the amount of expenses that was over 10% of your adjusted gross income. They have reduced that percentage down to 7.5%, so which means that you can claim an itemized deduction for more medical expenses than you could do before. Keep in mind that this is available only for 2017 and 2018. So if you end up having to itemize your deductions in 2018, then try to pay as much of your medical expenses in 2018 so that you can get the benefit of that particular deduction.
And that kind of assumes that you would qualify to take any medical deductions anyway, because even though they made it a little bit easier to get over that threshold, it's still a pretty big threshold, right?
Absolutely, absolutely. Like if we take an example of a person, let's just take 10,000 as your medical expense amount, or let's just for simplification, if we assume that your adjusted gross income is 100,000, previously with 10%, you would have to have more than 10,000 of medical expenses in order to get that deduction.
So the first 10,000 would not be deductible?
Would not be deductible anyway. And now with this change in the rule, 7,500 of that will not be deductible. But again, to have such a huge amount of medical expenses, in most taxpayers' cases, they may not have as much medical expense. They just
don't get enough to be able to make it count.
That's right. The next item has been, I'm sure all of our listeners have heard this mentioned over and over again in the news about the itemized deduction for state and local taxes. So under the previous law, in your itemized deduction section, you could take the state income taxes that you have paid during the year, the real property taxes that you have paid, as well as DMV fees as an itemized deduction. What they have done now is just limited that combined amount to $10,000. One thing to keep in mind is that if you were subject to alternate minimum tax in the previous years, then chances are that you didn't really get as much of a big benefit from that line item anyway. So again, you'll have to run the numbers to see how this really impacts your particular situation. But for now, they have limited it to just $10,000.
And that's a really good point, Anu, because a lot of people in the past, although it may be different going forward for AMT, alternative minimum tax, but once you're in AMT, they didn't get any tax deduction at all.
That's right.
So we add it up, we put it in, but until you run through the numbers, it looks like I have a big deduction before, and now I don't have. Now I've only got $10,000. If you were an AMT, you didn't have it anyway.
Right, and so maybe now you are actually getting a deduction, so it may end up being a good thing. But again, with so many moving parts as it relates to adjusted gross income, the amount of itemized deductions you have, AMT, things could end up being very different than what you anticipated. So just something to keep in mind. One thing to remember is that if you had state and local taxes that were related to your business or your rentals, those are still completely deductible on the respective schedule. So for example, if you had a rental property on which you were paying property taxes, those are still completely deductible against the rental income on Schedule E of your tax return. So this particular line item is just talking more about your primary residence on which you're paying property taxes, as well as the personal income taxes that you have paid. Mortgage interest. They have limited the amount of deduction that you can take on account of mortgage interest. Under the previous law, you could deduct interest on a loan amount of $1 million. What they have done under the new tax law is that they have reduced the loan amount to $750,000. This applies to loans that you have taken for the acquisition of your house, and they apply to purchases that you have made after December 15th, 2017. So it doesn't apply to your pre-existing loan on which you have taken mortgage interest deduction in the past.
And Anu, I think this hasn't changed. So you mentioned the personal residence, but the law is still in effect that we can take mortgage interest deduction on 2 homes if we own 2 homes, right? Up to 2 homes.
That's right. There was actually a lot of talk about taking it away for a second home, but looks like when they finalized everything, they kind of just left that second home provision in there. So now going forward, what you'll have to do is look at your mortgage interest, or look at your mortgage on your residence and your second home, combine them together, and then only the interest on loan amount of $750,000 will be what you can claim as an itemized deduction.
And this, I know you mentioned this, but I just wanted to reiterate that this has an odd effective date of December 15th. So it will actually impact people in 2017 if their mortgage balances, their original mortgage balances were over $1 million.
That's right.
Over $750,000.
So I think this is one of those provisions that actually did go back to 2017, one of the few provisions that did. So yes, you have to look at the date in which you bought your house. If it's, like you said, after this date, then you have to use the new rules.
And so we've noted here on the slide that if you have, currently your mortgage was over $1 million, this does not apply to you, even if you refinance. As long as you're refinancing that exact same loan balance, we're not talking about pulling money out, but if you refinance the balance that qualified for deduction under the old rules, then you don't have any problems. You can go ahead and refinance and still deduct interest, even if your loan was over more than the new $750,000.
Yeah, I'm sure that would be a relief for, you know, most of us to hear that they didn't change that. The next item is the mortgage interest on home equity loans. So if you had taken a home equity loan in the past, what you could do was that the interest that you paid on $100,000 of that home equity loan, you could claim that as an itemized deduction. However, going forward, they have eliminated this completely for not only just the new loans, the new credit lines that you enter into, but also the ones that are already in existence. So this will have somewhat of a retroactive effect in which going forward you have to pull out that $100,000 and not be able to claim a mortgage interest deduction on that amount. One thing to keep in mind is that if you have interest that have been paid for if the funds have been used for business purposes, that interest will still remain deductible. So just something to keep in mind when you're trying to figure out what your mortgage interest deduction is going to be.
So it's kind of a loophole.
It is kind of a loophole. You know, we like loopholes. So, you know, and this is one that we can probably, I guess we'll just have to ask more questions of our clients, you know, when they come in. Kind of, you need to know if you've taken a home equity loan that's not for the improvement of your house, then you kind of need to keep track of what you're using the proceeds for. So some additional record keeping there. Charitable contributions. Going forward, they have increased the deduction that you can take for the contribution to 60% of your adjusted gross income. Earlier, the limitation was 50%, so this is a good thing. They have increased the deduction that you can take for charitable contributions. One thing to keep in mind is that the charitable contributions have to be cash contributions. So this 60% limitation applies to cash contributions and if they have been made to qualified public charities. So just something to keep in mind when you're planning for your charitable contributions during 2018.
And if somehow you ended up making contributions that were more than 60% of your income, they'll carry forward.
They will carry forward. So
indefinitely?
I believe it's up to 5 years.
Oh, okay.
So you won't lose it completely. That's what it comes down to. The next item is, again, widely covered in the news, miscellaneous itemized deductions subject to 2% of your adjusted gross income. This deduction has been fully eliminated. What this used to constitute was the unreimbursed employee business expenses, safe deposit box fees, tax preparation fees, any kind of investment management fees that you were paying your investment advisors. All of that, they have completely taken away that line. And again, a lot of people most likely didn't get the full benefit because they were in the alternate minimum tax regime. And this was one of the add backs to calculate your income for AMT purposes. So again, it will remain to be seen if it really does end up affecting you personally. but from what I have seen is that if you have huge amount of investment income on your return and you have been paying investment advisor fees, then I can see that there most likely will be a very big change in the amount of tax that you end up owing at the end of the year. So just something to keep in mind as you go through your 2018 taxes. The other thing that they introduced, which again was just one of the things that is actually it's good for taxpayers, I think, is a new deduction for pass-through income. Chris, do you want to tell us a little bit more about this deduction?
Yes, I think this is probably one of the biggest benefits that were gained by taxpayers, individual taxpayers, in the new law. And it's a deduction for qualified business income of pass-through entities, or the Section 199A deduction. Individual taxpayers generally may deduct 20% of their domestic qualified income starting in the tax year 2018. And this deduction is a below-the-line deduction, so it is taken in addition to the standard or the itemized deduction. So pass-through entities include partnerships, LLCs that have not elected to be taxed as a corporation, as corporations, and trust and estates. Now, sole proprietors and real estate investors actually will qualify for this deduction.
And this was confusing, right, when those proposals first came out, because they call it pass-through.
Right, and I think some people thought, oh, do I have to create a new entity to take advantage of this law? And in the final law, no. So you can report your income on Schedule C, or if you're a real estate investor and use Schedule E to report your income, you will qualify for this. And the other good thing about this is that you don't have to make any distinction between active or passive income, so none of those laws apply. So that's a big win for taxpayers.
It really is. So either you can be a business owner and be working in your business, working hard, or you can just be a passive investor and you own a piece of the company, you don't do anything.
And
it really doesn't depend on the taxpayer at the first run-through of all these tests, but it's business income, as long as it's business income.
Business income. So you'll be eligible for this full deduction if you're a single taxpayer with taxable income under $157,500 or less, or a married taxpayer with taxable income under $315,000 or less. After that, there are some other tests that and hoops to jump through before you can get this deduction. Specified service businesses may qualify for the deduction if their taxable income is below the phase-out amount. And these specified business services include healthcare, law and accounting, performing arts, consulting, and athletics. So it's a much more restrictive set of criteria, but you will, within the income limits, be able to get this deduction.
So to recap, in simple terms, you really are going to end up being, if you qualify, you'll be taxed on 80% of your business income, and 20% will be tax-free.
Yes, I mean, it's as simple, well, it's not as simple as that, but I mean, theoretically, if you have a fairly simple business where you're not going to have to hit some of these other limitations, I mean, 20%. I mean, I think this is one of the biggest gains by far in the tax law.
It is. One of the limitations will be it can't be more than your actual taxable income.
Right. So some other provisions that were changed in the law.
Let me just throw in that ASL does have a specialized webinar coming up on this exact topic. So we've attempted just to kind of introduce the subject and to make people aware of it. But if you want to learn more about the ins and outs of it, our follow-up webinar, February 7th, and again, it'll be at noontime, we'll walk through a lot of the strings and hoops that you might have to jump through to make sure you get some or all of this deduction. Right?
I forgot that. So other provisions.
So I know Chris wants to tell us about other provisions, but I think I was going to throw in a little talk about AMT before we get to that part. And so just briefly, without going into a lot of detail, AMT was directly and indirectly impacted by the tax reform, but I think maybe more indirectly, it turns out, because AMT really relates to the changes that you would make to your ordinary income calculation or your regular tax calculation to get to your alternative minimum tax calculation. So as just a really quick refresher, AMT is a parallel tax system that all taxpayers, whether they realized it or not, all individual, well, for our discussion purposes, individual taxpayers had to calculate their taxable income under the regular tax rules, which everybody is obviously most familiar with, and the alternative tax rules. The main differences that we see in the AMT is the disallowance of specific itemized deductions. The biggies were taxes, so state income taxes, real estate taxes, sales taxes, if someone was taking that deduction, are all disallowed under AMT. So now that we only have a $10,000 maximum deduction on that side, it's not going to be such a big deal for AMT. So what's going to happen then is I think AMT is going to look more like our regular tax, or vice versa. The regular tax being disallowed, all those itemized deductions will look more like AMT. So that will probably make it end up that more people will not end up not being AMT. So it used to be an issue. If your AMT tax was higher, you'd have to pay the AMT tax. It may not be higher anymore. The other thing, a couple of the direct changes that were made to AMT were they increased the exemption amount before, well, they increased it. I'll just leave it at that, not by a huge amount. So there was an exemption, but not many people could actually take advantage of it because it phased out pretty quickly as your income got higher. Now more people will be able to actually use the AMT exemption and exempt some income from being taxed under the AMT rules. And more people will probably not even get that far because their income, ironically, will be higher under regular tax. So that's how you get out of AMT, is you have higher regular tax. So at the end of the day, you just have to run the numbers and see if you end up in AMT or not. I've seen it go both ways. I've seen people who used to be in AMT in 2017 will be in AMT under 2018, but will still save taxes. We'll still have lower taxes. And I've seen it the other way around too, where people who were in AMT before will in fact have higher taxes under the tax reform laws. So again, it all depends on your specific situation and your specific mix of income and expense items. So Chris, now please tell us about the other provisions that you're excited about.
So some of the other provisions that were changed in the new Tax Act on Roth conversions. Now typically you could do a Roth conversion at the beginning of the year, and at the end of the year, for whatever reason, if it didn't seem like it was going to be advantageous, you had the ability to basically undo that Roth conversion. That's been taken away. There's no more do-overs for Roth conversions in 2018. This is a plus. IRC Section 529 plans now up to $10,000 per year can be used to pay tuition for K through 12 education, which is including private elementary and high schools, and those earnings on the 529 plan will be tax-free to the taxpayer. In meals and entertainment business expenses, there's no longer any deduction allowed for entertainment expenses, such as golf outings or professional sporting events. Now, the business meals will still be deductible, but up to the 50% limitation, and that's also been expanded to limit most meals provided to employees. A note here, employee meal deductions will be completely disallowed beginning in 2026.
Before we move on, Chris, sorry, I just wanted to re-emphasize the Section 529 plan change, because this is going to be a really big deal for people whose children are going to private schools, and that's high schools and elementary schools. Unfortunately, because of the way the 529 plan works, it's not an immediate deduction because, like you were saying, it's really the tax-free nature of the earnings on contributions that where the benefit comes in, right?
Right.
So it's a long-term planning strategy.
Right. So you might want to encourage under this grandparents setting up 529 plans, you know, for their grandchildren as soon as possible.
Right. Or parents.
Or parents, that's true. Always hit up the grandparents first.
Right. Yeah, good idea.
So under the tax-free exchange, section 1031, there have been a few changes. It now is only going to apply to real property. So you potentially could have a gain if you trade in equipment on a new piece of business equipment, or if you trade in a car that's been used in business on another car. Also keep in mind that if you've had a cost segregation study done on your building, you may have to do some extra calculations to be able to accurately compute the 1031 gain. For health insurance coverage, the individual penalty for not having health insurance is repealed, but unfortunately it's only after 2018. So it will apply in 2018, but it is repealed in 2019. Now, kiddie tax rules, this was something that came as something of a surprise. In old tax law, kiddie tax, the kids were always taxed at the parents' highest marginal ordinary income level, except for some haircuts for unearned income. But now, unearned income will be subject to the same tax rates as they apply to trusts and estates. And that is, as you probably know, a very compressed set of brackets that still are reflecting the point or two reduction at each bracket, but at $12,500, a taxable income in a state or trust will hit the highest marginal bracket. But earned income will be subject to the same rates as an unmarried individual. So that is a big change. So some provisions that didn't change, capital gain exclusion on the sale of a principal residence under Section 121 did not change. The gain will be excluded for properties that the taxpayer owned and lived in for 2 of the last 5 years.
And this was kind of a scary proposals that were coming through that were going to change the way that the Section 121, that you qualified, you had to live in it longer.
And also, I mean, in California, if you've owned your house for any period of time, you know, $500,000 may sound like a lot of gain exclusion in certain areas of the country, but here it's not.
It's real.
Having them retain at $250,000 for single and $500,000 for married is still a great tax benefit.
And for people who are planning to sell in the near future, the rules weren't changed, pulled out from under them, basically.
Right.
And they had to maybe stay and live longer in their house.
So the educator expense, that had been there had been changes proposed to that. It is unchanged at $250,000, and it is an above-the-line deduction. Student loan interest is also a deduction up to $2,500 per year, but that is subject to income limitations.
So we don't have a whole lot of time left, and we wanted to leave some time for Q&A at the end. So I will briefly talk about just a couple of tax credits that we wanted to make sure you are aware of, and then we'll run into some of the estate and trust rules. The federal tax credit that saw some significant changes was a child tax credit. The credit was $1,000 per qualifying child under the old rules, and now that's increased to $2,000, so that's a nice jump up. The refundable amount of tax per child has gone up to $1,400. So you could actually, if you've offset all your taxable income and you still have unused credit, you could get some of that back as a check, so that'll be nice. I think this helps offset the fact that with the repeal of the personal exemptions, families especially who are benefiting from personal dependency exemptions for children, they've lost that, but in exchange they've gained some additional child tax credit, so that's a good thing. Another change that was made that's actually a pretty big change for families is the phase-out income levels have increased so that families now up to $440,000 in income could still get at least a partial, if not all of, well, not all of them, but they can still get a partial, up to $400,000 a full credit, let me say that, and it doesn't phase out until $440,000. So these are some pretty big numbers as compared to previously, where the phase out was between $110,000 and $150,000 of income. So a family who had $400,000 of income in the past would not have been able to, I mean, even $151,000 of income would not have been able to take this credit at all. Now, up to $400,000, they can take full advantage of this credit, so huge deal. And the other additional change was the addition of the $500 family tax credit for dependents who are not your children. So that typically that would probably be elderly parents that you're helping to support who qualify as your dependent. A state tax credit that is not new, but I think will be especially beneficial, or it could be something to take another look at with the reduction in itemized deductions, is the California College Access Tax Credit, which actually also provides a federal benefit. What this fund is the state of California has a fund that is used to fund the Cal Grant program. Cal Grants are the scholarships for low-income students in the state. A taxpayer who makes a contribution to this fund gets to take a 50%, and this is upfront, dollar for dollar, 50% state tax credit. So that's like paying your state taxes directly for them, basically, at half of your contribution amount. So say you contributed $10,000, you've just made a $5,000 payment of your state tax credit, your California tax credit. On the other side, a contribution of $10,000 is a straight $10,000 charitable contribution deduction on your federal tax return. So here you've got the, if you're in the maximum new federal tax rate of 37%, you've just saved $3,700 on the federal side, plus the $5,000 on California side. So you've got an $8,700 back in your pocket, basically, on a $10,000 contribution. So especially if you would be charitably inclined anyway, this seems to be kind of a no-brainer. The caveat is that you have to apply ahead of time. You have to do a very simple application online. Has been due by November 30, so that probably will be the same this year, and you may have to make the contribution before the end of the year. So something to take a look at before you get into December, and we do have a link at the bottom of our slide here that will direct you to some more Q&As and information about 2018 isn't quite up yet, but I think that's coming up in March, but it'll still give you some details so you can use that in your planning. I knew.
Okay. So all right. So far we have been talking about federal tax reform. So let's just switch gears and talk about California. California conformed to the federal law as it was in place on January 1, 2015. So none of the changes that have been made to the federal taxes due to this new act have been made yet for California. So as you can see, the slide kind of lists the different items to which California does not conform, and it's almost as if now you have to kind of just recalculate California income in a completely different way than we used to before, because so many changes have been made to the federal adjusted gross income which don't apply for California. So you can still claim a full deduction for your real property taxes. You're not limited to the amount of $10,000, and so just keep in mind that it's just going to be fairly different for California. So there will be significant adjustments that will have to be made to the California adjusted gross income. And then, Chris, do you want to cover the estates and trusts changes for us?
Sure. The 2018 federal estate and gift tax unified credit went up to $10 million per taxpayer indexed back to 2011, which makes it about $11.2 million per taxpayer. Now, this is actually set to sunset before 2026. It will be sunset. So this is a planning opportunity for people, particularly in the $5 to $6 million taxable estate range in terms of gifting and potentially utilizing this higher exemption to move assets out of their estate, particularly if that exemption does fall to the $5 or $6 million range that it's supposed to. The annual gift exclusion for 2018 is up from $14,000 in 2017 to $15,000 per donee. Now, the new law did have some implications for trust income. The miscellaneous itemized deductions, those are now subject to 2%, are now also not allowed for a trust. Now, there are some other deductions such as fiduciary fees and actually accounting fees, legal fees, that are not subject to 2% in a trust. So that remains to be seen. Hopefully they will still be 100% deductible. That $10,000 cap on real property taxes and income taxes does apply to trusts and estates. The good news is the 20% deduction for pass-through entities applies to trusts and estates that are distributing, and actually for income that has been retained in the trust that maybe came through a pass-through like a real property. They will also be able to take advantage of that deduction.
So, Chris, I don't know if most people realize, but income taxes for estates and trusts is based on individual tax rules, right?
Yes. So that's why the miscellaneous itemized deductions are gone. However, there is in law there is for the types of deductions and expenses that are incurred for having assets in a trust are actually fully deductible, so there may be some clarification on whether that applies or not.
So at first blush, we generally would tend to think that if it applies to individuals, it applies to trusts.
Right.
But there are some nuances with trusts that need to be figured out and
hopefully they'll be clarified by the time we have to file 2018 tax return. So trust and estate, the tax rates, there has been a reduction to 4 brackets. These brackets also reflect the lower tax rates at those brackets. This is also kiddie tax. Kids are going to be assessed tax at these rates, so that's an opportunity to maybe split the income between the minor child and the trust. And the $600 exemption for an estate is still allowed under 2018 law. It's $300 for a trust that must distribute its income currently, and $100 for a complex trust.
So I think that's all the materials that we wanted to present to you. Let's see if we have some questions here. We're clicking. Is that a yes or a no? Yeah. Yes. Okay, someone has a general question, which I was going to say at the end, but I'll just throw it in here now. It looks like the webinars are recorded. They are, and they'll actually be posted to our YouTube channel, ASL-CPA, today or tomorrow? Tomorrow, probably tomorrow. So as they happen, they are being posted, and they should show up the day after we record them. The materials will be available on our website as well. What happens to the 3.8% impact on capital gain tax rate? Nothing. It's still around. It's still around. Although I believe it will be impacted by the fact that we can no longer reduce it by state income taxes. Is that right?
It will be limited. The state income tax reduction against that would be limited. So, but there will be no impact to the 3.8%. It's still there. The next one is in the Madrid filing jointly income limit 415,000 for
no, it's 315. Actually, if you look at the tax brackets for individual taxpayers, it is the lowest income level at the 32% bracket.
The 24% bracket.
24%.
And that's the same for individuals and for married filing jointly. So the limitations, the $157,500 and the $315,000 limitations are at the top of the 24% tax bracket, and that's the 100%. if you go above 400, I don't recall an income limitation, but again, this detail is going to be in our follow-up webinar, so that's on February 7th.
Okay, so this is in the past, LLC members of a hotel LLC had to be treated as active subject to Social Security. Is that still true? I think what we were talking about was really for pass-through entity deduction. It really had nothing to do with the character of the income under certain other tax laws, so I don't think that's going to change.
That sounds like that's not an income tax question, so I'm sorry, we're not familiar with that.
Okay, for S-Corp owner, is it now better to minimize W-2 income and maximize profits to get the 20% deduction? That answer is depends, and I think this would be, particularly to answer this question, you really need to listen to the pass-through webinar because it's going to go into more detail of how this is calculated. Particularly the higher the income, then there's other things that you need to look at. So
I think if you're not able to fully get the deduction, then you start looking at some of these other planning opportunities for shifting your income around.
Correct.
And seeing what's going to end up benefiting you the most. Are holiday parties affected by the changes to the meals and entertainment business expense laws? Yes.
Yes, it is. I mean, that's kind of sad, actually, you know.
And I think that's the gist, that's the whole change. Unfortunately, they will be still allowed 50% deduction, where in the past they were allowed 100% deduction for these specific types of meal and entertainment expenses.
Okay, if you have a grandfathered mortgage with a balance of $750,000 and purchase a second home, would you not receive a deduction for the interest since you already at the cap? You are already at the cap rate, or is each mortgage treated separately from your personal and second home? No, the cap is $750,000.
So for a grandfathered mortgage, you would still get interest deduction of up to $1 million.
But her grandfathered mortgage in this question is already at $750,000, so she's not able to increase
for the second
that.
Home,
right. There's no
so for any new transaction, you'll have to kind of look to see what the mortgage amount is going to be.
So it's a combined limitation. If you're already at that limitation, even with the grandfathered loan, there is not an opportunity to increase it. Energy credits and electric vehicle credits impacted? No. Not that we've seen. We actually were thinking about talking about the energy credit, but we decided since it wasn't changed under the new laws that there was really nothing to say.
Right.
So they haven't been changed. What do you plan? I don't know. So I think we're good. Thank you for attending today. I think there's going to be a brief survey popping up. Again, our materials will be on the website, and the recording will be on ASL CPA YouTube channel. Thank you.